Hey everybody, welcome back. Today we are going to talk about how to become a digital real estate investor and what does that mean. So, have you ever thought about really wanting to get into real estate, owning a couple of properties, maybe hiring a property management company or doing all of the property management yourself and just reaping the passive income for years and years and years? Sounds like a nice dream, a nice fantasy, really. But to be honest, it's a lot of work. It's a lot of hard work on top of the hard work and the commitment that it takes to be a real estate investor of physical properties. It also takes money. So that's one thing that I know is very difficult to come by these days is the actual capital, whether it be the down payment or paying the mortgage or different expenditures and expenses that come with owning a property. So that's why our topic today and our tutorial today, I love this. I love this topic. I love the idea of this because it allows anybody to be able to get in and be a real estate investor digitally. And the way we can do that is by buying into what's called a REIT. So it's REIT, REIT. So what is a REIT? So basically, a REIT or a real estate investment trust are companies that own finance income producing real estate across a wide range of different sectors. And what that means is different industries as far as you can think. So basically what it is you have a company and they buy up commercial real estate, maybe even potentially some residential real estate, different industries, restaurants, bars, shopping malls, apartment complexes, apartment buildings, condos, all that kind of stuff. The company itself, they buy all this stuff with their own money, their own capital, whether it be some sort of a loan or some sort of internal capital. And then you as an individual, you can buy in to that REIT, buy into that company. Otherwise, you can buy in as an individual, buy into their stock individually, or you can also buy into an ETF, which is also known as an exchange traded fund. So that is like kind of like a buffet or like a blender, a smoothie of companies that are put together in one individual stock. You can buy that versus buying an individual company stock. So let's take a look. What assets do REITs own? So this is a wide span right here. And this is not a full list, but this is just to give you guys an example of what may be contained in a REIT, what assets may be contained. So as we mentioned, there's a wide range of real estate property, different buildings and types, and they include, in no particular order, offices, apartment buildings, warehouses, retail centers, medical facilities, data centers like IT, cell towers, infrastructure, hotels. That's a large list of different things that can be part of this REIT. So there's a lot of possibility and there's a lot of opportunity for income all across those different sectors. So that's why I like this so much, is because it's such a wide, diverse range, and basically the options are endless for the most part. So we're going to go down here, and if you think to yourself, why should I invest in REITs? Why couldn't I just stick with typical stocks or bonds or that kind of thing, mutual funds or regular ETFs? Well, kind of like back what we mentioned in the very beginning, if you don't have the capital for real estate to buy into real estate, you don't have the down payment, you don't have the expertise, you don't have the knowledge to get into real estate, and you don't have money that you can actually, we'll just say burn, this is a great option because all you're really doing is you're trading your money for a piece of the company, also known as a piece of the stock. So basically the only negative side to that, or the only risk for you, is if the company itself isn't making money. But as you can see, a lot of these different assets, it's very difficult for some of these things to not make money. I mean, regardless of what the economy is, or regardless of what kind of climate we're currently in. So these are evergreen properties. These are always going to be around. People are always going to need these specific properties. So why invest in REITs? So competitive total returns. So what that means is, on a typical stock, you're looking at getting a dividend yield where the company pays back its shareholders anywhere from potentially maybe 1 to 3, 5%, and that might be on the high end. But some of these REITs, pay 2-3 times that. So depending on the cash flow and how well they're doing as far as income producing. So produce high and steady dividend income, like we just mentioned. The more money that the REIT, the company, is making in their real estate venture, the more money they're going to give back to the shareholders, which is awesome because that's a win-win. So it's an excellent portfolio diversifier. So that means if you don't want to lay all of your eggs in investing baskets such as technology or gas or oil or something of that sort, maybe any other kind of sector you can think of, entertainment industry, this is a great way to add a real estate portion into your investment portfolio without owning the physical real estate. So that's pretty awesome. So finally, to reduce the overall portfolio risk, and it increases returns. So basically, if you put all of your eggs in one basket, so to speak, and you're just investing heavily into, we'll say, Apple, and you have hundreds of thousands of dollars or thousands of dollars or hundreds of dollars just in Apple, and something happens and Apple goes down and crashes hard, then all of your hard-earned money for the time being is going to drop. So that's why it's best to put your hands in different, your feelers out there, and get your hands into different types of portfolios in order for you to be able to make money. So it's just another avenue for you to make passive income, basically through dividends. So let's take a look at how do REITs actually make their money? How do they make their money? It sounds pretty simple, but let's take a look at it. So basically, most REITs operate along a straightforward and easy to understand business model. Typical and normal commercial real estate, by leasing space and collecting rent on its real estate, the company itself generates income and then is paid out to its shareholders in the form of dividends. So basically, think of it like a pizza. So if you have a pizza, so the pizza as a whole is the company. So every slice is a share, and every time that somebody buys a share, they're called a shareholder, and now they own a piece of that pizza, the slice, and that slice is a REIT. So when that pizza itself makes money, everybody that owns a slice of that pizza, they will then in return earn money in the form of a dividend, and that can get paid anywhere from, sometimes yearly or monthly or quarterly. It really depends on the company itself. So this is a big one, this next one. So REITs must pay out at least, this is huge, 90% of their taxable income to shareholders, and most pay out 100%. So basically, what does that mean? So that means that the REIT itself, the company, is not allowed to keep more profit for themselves. They have to share it with the shareholders. So they're not keeping like some secret bank vault of like millions of dollars that they're not giving out to their shareholders, which is awesome. That's another huge bonus in order to, entice people to invest in their company or their share, the REIT. So the only catch right here is this next line, but I don't want this to be a reason why you don't consider investing in REITs. So in return for owning a REIT, the shareholder, whoever owns a share, does have to pay income taxes on those dividends. So for example, if the company is doing really well, and let's just say they make $1 million, and let's just say, this isn't exact numbers, but let's just say they pay out, we'll just say $100 in dividends for every quarter, right? So every quarter, so that's 3 months is a quarter. So about $400 a year, we'll just say that. This is not concrete, this is just an example. So out of that $100, that's going to be considered income for you as the shareholder, or me, or whoever owns the share. So you're going to have to pay taxes on that when it comes to tax time. But that's not something that should deter you. I think the pros far, far outweigh the cons in terms of just paying the income taxes, because think about how much money you can make. So next, one of my favorite parts, how do you invest in REITs? How do you actually invest in them? It's really simple, actually. So an individual, you or myself or anybody, you can buy a share of the stock like we talked about earlier. So they're listed on every major stock exchange, just like any other public stock. Investors can also purchase shares in a REIT mutual fund or an exchange traded fund, an ETF. And the reason why I like ETFs is because it's a conglomerate, it's a buffet, if you will, of different companies. So a bunch of these different real estate companies all come together and they form this ETF, which is basically like a group of these companies. And in my opinion, I'm not a financial advisor. This isn't financial advice, but I feel like that's safer to invest in an ETF only because I feel like the risk of every company that's in that REIT is a lot lower than investing in an individual REIT. So that's something you have to kind of think of yourself, what the risk is, the reward versus the risk. So that's something just to think about as you get into this, if you want to try this. So if you're still here and you're still watching, I have 2 bonuses for you that I want to share with you guys. So one of them is, according to Forbes, here are the 7 best real estate ETFs of 2023. So all this information that you're about to see is sourced from Forbes. This isn't from me. This is from Forbes. And even list this source down below. So here's the top 7 ETFs, REIT ETFs, according to Forbes. So number 1 is Vanguard Real Estate ETF. Vanguard you can always count on as being a solid ETF. It doesn't matter if it's a REIT or something else. And they produce a 4.12% dividend, which is pretty good. I mean, that's in that span right there. Number 2 is the Van Eck Mortgage REIT Income ETF. That's got a whopping 13.52 dividend yield. That's extremely high. So that might be something to look into if you're looking at something with a high dividend yield. Number 3 is Goldman Sachs Future Real Estate and Infrastructure Equity ETF. That's at a 1.82% dividend yield. Number 4 is Xtrackers International Real Estate ETF, which pays out just over a 2% dividend yield. It's important to mention the international ETFs because just because we live in America, well, I live in America, depending on where you live, it's good to diversify in different parts of the world too. It doesn't mean that you have to live there. Just by investing in it, that means that you're getting a piece of real estate properties around the world, which is really cool. So next is Invesco Active US Real Estate ETF. That comes in at a 2.95 dividend yield. Next we have iShares Residential and Multi-Sector Real Estate ETF. That's a 3.36 dividend yield. And finally, another Vanguard Global X US Real Estate ETF. The dividend yield is not as great on this one, but once again, it's Vanguard, so you know it's going to be solid in terms of producing passive income in the form of dividends. The dividend amount may not be as much, but it's still something that you're going to want to look into and do your own research for. So next up, we have the second surprise. Here we go. I'm going to get into Robinhood here, and I'm going to show you guys what some of these look like. So first thing we're going to do is, here's how to search for these ETFs. You can either search for the call symbol itself, the ticker symbol, or you can search for the entire ETF, the name. So we're going to go over to Robinhood. We're going to go to search. And then all you have to do is you have to select it right here. So this is the first one, the Vanguard US REIT Fund. So as you can see, this one currently is at about $81 a share, give or take. So you pay $81 to buy into this REIT. So if we scroll down, it gives you a little bit more information about the REIT itself. It gives you the number of holdings. Scroll down and it divides the sectors itself. So real estate is a primary sector for this specific REIT. And then we're going to go down, take a look. And here are the top 10 holdings that make up this individual REIT right here. So you can go here and you can take a look: Public Storage, Equinox, American Tower. And then if you go down to key statistics, this is a good indicator of, some of the past statistics. So for example, what's the high? The high today would be $81.89 for the share. The 52-week high, that means in the last year, what was the highest that this stock itself was listed at? And that was $109 that you could buy it for. So it's come down quite a bit, like a lot of other things. The 52-week low is $74.66, and it looks like they pay their yield out every 30 days, and that the yield percentage is 2.83%. So let's go back over here and let's take a look at another one. Let's take a look at this one because this one's got a really high yield. So let's click on this, copy this ticker symbol, and we'll paste it in here. And we'll just to show you the difference. So this one, the share for this Van Eck Mortgage REIT is a little about $10.50 for one share to buy into this REIT. So again, it gives you some information here, and then it gives you the top 10 holdings. So I'm not really familiar with a lot of these as far as like the holdings that are a part of the REIT itself, but I like to go down to the key statistics because that's where you get the most information. So you take a look at the high, the yearly high, what it was in the past year, and then the 30-day yield is even higher than Forbes predicted. So it was 14.58%, which is huge. So this might be something if you're considering investing into a REIT, maybe consider investing into this one. But as always, do your own research. This is just an introduction to REITs, explaining what they were, and kind of giving you some more educational information on why you may want to diversify your portfolio. Thank you guys so much for sticking around. If you're still here, I would like to invite you to please hit the like button if you got benefit out of this content. If you liked it, if you enjoyed the video, please consider subscribing. That would really help us on this journey and help us reach more people, have our content reach more people. So we really appreciate your support. And one final bonus. So I'm going to put a link in the description down below for a free stock. So if you're not a member of Robinhood and you would like to actually sign up for a brokerage account, it doesn't cost any money. All you have to do is, it doesn't cost money to sign up. You can put in a couple bucks, 5, 10, 15, 20 bucks into your account. And if you use the link that I provide, because I'm already a member of Robinhood, then we can both get a stock. So that's it. There's no smoke and mirrors. There's no strings attached. We each get a stock. There's no guaranteeing what the stock is, but if you'd like to take advantage of that, I'll put the link down there if you want to check it out. So once again, I really appreciate your support. Thanks again for watching. Until next time, be well, be safe. Thank you.